As the U.S. stock market enters a period of increasing divergence at elevated levels, investors face a fundamental question. What kinds of stocks should they buy to avoid bubble risk while continuing to generate returns? Intense market volatility is reshuffling the market's favorites. Capital is increasingly favoring stocks with cash flows and business models that remain difficult to replace even during periods of volatility. In other words, stocks with price resilience. Today, we will examine three companies: Microsoft, Apple, and Visa. They operate in three entirely different industries: software, consumer electronics, and financial technology. But they share the same defining characteristic: price resilience. 1. Microsoft, the rent collector of enterprise software. Microsoft's resilience is built on two irreplaceable structural advantages. First, the lock-in effect of its enterprise ecosystem. Windows, Office, Azure, and GitHub cover the entire chain, from operating systems and productivity tools to cloud computing and developer platforms. Once an enterprise becomes deeply embedded in Microsoft's ecosystem, the cost of migrating away becomes extremely high. This is not merely customer stickiness, it is infrastructure lock-in. Financially, Microsoft's commercial remaining performance obligations, or commercial RPO, reached $627 billion in the third quarter of fiscal 2026, representing year-over-year growth of 99%. This $627 billion in contracted orders that have not yet been recognized as revenue provides Microsoft with several years of revenue visibility. No matter how the stock market fluctuates, these contracts will not disappear. Second, its first-mover advantage in AI monetization. Microsoft's AI narrative is fundamentally different from that of other companies. As of March 31st, 2026, the annualized revenue run rate of Microsoft's AI business had exceeded $37 billion, representing year-over-year growth of 123%. The number of paid Microsoft 365 Copilot seats surpassed 20 million, while new seat additions grew 250% year-over-year. Azure grew 40% year-over-year in the third quarter of fiscal 2026. The company guided for growth of 39% to 40% in the fourth quarter and explicitly stated that customer demand continued to exceed available capacity. Supply cannot keep up with demand. Third, disciplined capital returns. Microsoft holds more than $90 billion in cash and short-term investments and is expected to generate more than $70 billion in free cash flow in fiscal 2026. $70 billion in cash reserves, $627 billion in contracted orders, and $37 billion in annualized AI revenue. These three figures form the triangular foundation of Microsoft's price resilience. Now, let us look at Microsoft's candlestick structure. All of its major moving averages, MA5, MA10, and MA30, are tightly clustered between $388 and $392, forming a support band approximately $4 wide. The current price of $401 is about $9 to $13 above the support band, placing the stock in the extension phase following a breakout. The historical high marker, MA1, points to $490.12, which means the current price still has approximately 22% of potential upside before reaching its previous high. At $401, the stock is trading about 2.4% above its MA5, indicating a relatively elevated short-term deviation. For investors establishing a new position, waiting for the price to pull back toward the MA5 at approximately $391 to $392 would offer a more cautious entry window. If the price shows signs of stabilization in the $390 to $395 range, such as a low-volume doji or a lower wick, it would confirm support around the moving average cluster. There is no obvious moving average resistance above the current price. However, the round number levels of $420 and $450 may act as psychological resistance, while the historical high of approximately $490 serves as a longer-term reference target. 2. Apple, the low-capex toll collector. Apple's price resilience logic is equally clear. First, its strategically differentiated approach to capital expenditure. In 2026, AI-related capital expenditure by hyperscale technology companies is expected to exceed $725 billion. Microsoft alone is expected to spend nearly $190 billion in capital expenditure during fiscal 2026. Apple, by contrast, has historically maintained annual capital expenditure of approximately $12 billion. This reflects a fundamental difference in strategic choice. Apple does not train large foundation models, build massive data centers, or participate directly in the AI arms race. Its logic is simple. Allow other companies to spend hundreds of billions of dollars training AI models, and then allow those models to run on 2.5 billion Apple devices. Second, exceptional cash flow conversion. Apple generated net income of $112 billion in fiscal 2025, representing year-over-year growth of 19.5%. Free cash flow reached approximately $99 billion. During the first half of fiscal 2026, Apple's free cash flow margin expanded to approximately 32%. The use of this cash is highly concentrated. In fiscal 2025, Apple repurchased $90.7 billion of its own shares. In April 2026, the board authorized another $100 billion share repurchase program. During the earnings call, Tim Cook stated that Apple had returned more than $1 trillion to shareholders in total, of which more than $850 billion had been returned through share repurchases. Third, the key catalyst in the Chinese market. On July 15, 2026, China's cyberspace regulator approved the registration of Apple Intelligence in China. Apple chose to establish deep partnerships with Alibaba and Baidu. Alibaba's Qwen model will be integrated into Apple Intelligence to provide Chinese users with text and image understanding, content generation, and other capabilities. Baidu will be responsible for developing AI-powered search functions and localized upgrades to Siri. The commercial significance of this development is clear. Apple sales in Greater China reached $20.5 billion in the second quarter, representing year-over-year growth of 28%. The launch of Apple Intelligence could further reinforce this momentum. More importantly, Apple's AI strategy has now been validated in the Chinese market. Apple does not need to develop its own China-specific foundation model. Instead, it can integrate models provided by local partners and deploy AI functionality at the lowest possible compliance cost. Apple does not need to become the leading AI model developer. It can still become the toll gate for AI services in the Chinese market. Fourth, the rebalancing of valuation and earnings. Apple currently trades at a forward price-to-earnings ratio of approximately 33 to 34 times. The market's willingness to tolerate this high valuation rests on two conditions: approximately $100 billion in annual free cash flow and nearly $100 billion in annual share repurchases, which continue to increase earnings per share. As long as these two conditions remain unchanged, Apple's valuation will continue to receive support. Apple's current candlestick structure is as follows. The current price of $333.26 is already very close to the historical high of $334.68. Once the stock breaks above that level, there will be no historical moving average resistance overhead. For investors who have not yet established a position, there are two possible entry approaches. The first approach, following the breakout. If the price decisively breaks above $334.68 and remains above that level, it would indicate that additional upside has opened up. Investors could enter after the breakout is confirmed, with a stop loss placed below the previous high at approximately $328 to $330. The second approach, waiting for pullback confirmation. Investors could wait for the price to make a new high and then naturally pull back toward the MA5 at approximately $321 to $322, or the MA10 at approximately $316 to $317. They could then enter after support is confirmed in that area. This entry position would provide a tighter stop-loss structure, with the stop placed approximately 3% to 5% below $316. 3. Visa. benefiting from AI without building AI models. Visa operates a global payment network. First, the lightest asset structure and the highest conversion rate. Visa generated $21.6 billion in free cash flow and $23 billion in operating cash flow in fiscal 2025. During the same period, capital expenditure amounted to only $1.5 billion. This means that Visa converts almost all of its operating profit into free cash flow. In terms of dividends, Visa has increased its annual dividend for 17 consecutive years. Its most recent increase was 14%. The current dividend payout ratio is only approximately 21.5%, while cash coverage is close to 5 times. In the second quarter of fiscal 2026, Visa repurchased $7.9 billion of its own shares in a single quarter, setting a company record. Second, self-reinforcing network effects. Visa processes approximately 100 billion transactions each year, with annual payment volume exceeding $5 trillion. In the U.S. market, Visa accounts for approximately 38% of credit card transaction volume and 61% of debit card transaction volume. In the second quarter of fiscal 2026, payment volume reached $3.7 trillion, representing year-over-year growth of 9%. Cross-border transaction volume increased by 11%, while the number of processed transactions reached 66 billion, also representing year-over-year growth of 9%. The value of a payment network increases as its scale expands. More merchants accept Visa, more consumers use Visa, and more banks issue Visa cards. This creates a continuously self-reinforcing monopoly. Third, a passive beneficiary of the AI trend. Visa does not bear the capital expenditure required to build AI infrastructure, but it still benefits from the widespread adoption of AI. AI-driven growth in e-commerce, the expansion of cross-border payments, and the increasing adoption of digital wallets will all increase the volume of transactions processed through Visa's network. Visa's management has stated that AI and agentic commerce will expand the company's addressable market. Third-party estimates suggest that AI adoption could contribute between 80 and 150 basis points to global GDP growth. Visa now has more than 160 stablecoin-linked card programs, while annualized stablecoin settlement volume has reached $7 billion, representing sequential growth of more than 50%. This further demonstrates Visa's ability to expand into new digital payment use cases. From a technical perspective, Visa's MA5, MA10, and MA30 are all concentrated between $325 and $329, forming a dense support band approximately $4 wide. However, the current price of $365 is already approximately $36 to $40 above this support band. The deviation exceeds 11%, which means the stock is in an extremely extended short-term position. From a technical analysis perspective, this condition would generally not be regarded as an ideal entry point, because the probability of the price reverting toward its moving averages is relatively high. Investors can wait for the price to pull back into the MA5 to MA30 range at approximately $325 to $329. This area is where the three moving averages converge. If the price pulls back into this zone and receives confirmation of support, it would form a standard buying structure around the moving average cluster. A stop loss could be placed below the MA30 at approximately $320. 4. Three types of price resilience, one common characteristic. The price resilience logic of Microsoft, Apple, and Visa can be understood as follows. Microsoft's price resilience comes from the fact that once an enterprise becomes deeply embedded in Microsoft's ecosystem, the cost of migration becomes so high that leaving is almost impossible. The company's $627 billion in contracted orders is direct evidence of this lock-in effect. Apple's price resilience comes from its 2.5 billion active devices, which form the world's largest hardware distribution network. Any AI model that wants to reach hundreds of millions of iPhone users in China must pass through Apple's distribution channel. Visa's price resilience comes from the scale effect of its payment network. $5 trillion in annual payment volume and 100 billion annual transactions form a self-reinforcing two-sided network. The more people use the network, the stronger it becomes. The stronger the network becomes, the more people use it. These three types of price resilience share the same underlying logic. None of these companies relies on the monetization of AI technology to maintain its profitability. Microsoft does not need to invent the next large foundation model. Apple does not need to follow the trend of rapidly expanding AI capital expenditure. Visa does not need to build data centers. They simply need to keep their existing ecosystems operating, and they will continue to generate cash flow. As the market shifts from chasing concepts to embracing certainty, business models that can continue generating cash flow without relying on technological breakthroughs deserve serious attention from all investors. The strong performance of these three stocks represents the market's vote for companies with genuine price resilience.